Hey everyone, welcome to Finance with Avery. If you're new here, don't forget to hit that subscribe button. And if you like the video, then like the video. Today, I'm diving into the world of certificate of deposit accounts, also known as CDs. Are they the right choice for you and that lump sum of money you have, those extra gains, the extra savings, that cash pile you're sitting on? Are CD accounts the right choice for you? I'm going to get into the pros and the cons of CD accounts. And also towards the end of the video, I'm going to show you and talk about specific CD accounts and rates that are currently offered out there, and I have the video organized into chapters down below so you can jump around and skip to different sections back and forth and all of that. First here, let's get into the pros of CD accounts. First up here, one of the first pros of CD accounts is that it is a guaranteed stable yield and rate of return. So with these predictable returns, you know exactly how much interest you're going to earn each month and at the end of the term. There's no market volatility and no kind of fluctuations, no matter what's going on with the economy, the stock market, presidential elections, this and that, oil prices, all that, whatever. That rate on that CD account is going to stay the same for the length of the CD, the term of the CD. So it is a safe type of investment. And yes, it's an investment because you're putting money into it, but this is one of these safer investments out here. It is a guaranteed rate of return. Even before the CD and the term is up, you know pretty much how much money you're going to gain from interest on that certain amount of money that you put into the CD. So that is definitely a pro with a CD account. It's a guaranteed stable yield and rate of return. And there's no kind of guessing of how much you're going to gain on the money that you invest in a CD, and also no kind of worries about, okay, is the principal of my CD going to go down? I put a $10,000 in this CD. Is it going to go down to $8,000 when I withdraw it and I'm ready to, take the money out when the term is over? No, not at all. With the CD account, that principal is safe. So that amount of money you put in there is going to be there when you take out, plus the interest that is earned on top of that money. So it is a guaranteed stable yield and rate of return on a guaranteed amount of money as well, where you don't have to worry about losing your principal or wondering how much you're going to gain on your principal. And when I say your principal, that's your initial amount that you put into the CD. The principal amount is the amount that you put in the CD. So if you open up a CD with 25,000, that's your principal amount. 30,000, that's your principal amount. 100,000, your principal amount is 100,000. So that's what I mean by that. Now let's jump into the next pro. The next pro is that typically CD accounts offer higher interest rates and higher yields than savings accounts. Now, yes, there are definitely high yield savings accounts out there, and I talk about those accounts on my channel often. And every other month, I make a ranking video of the top 10 savings accounts ranked by APY. And so there's some nice APYs out there. I'm very familiar with the yields and interest rates of high yield savings accounts. And yeah, they're definitely comparable to CD accounts. Now, there is some fluctuations. Typically, CD accounts are going to be a little bit higher than savings accounts in general, definitely. And when you talk about just basic savings accounts, not high yield savings accounts, yeah, CD accounts typically are going to be much higher. Not all CD accounts, though. There are some big banks out there that offer very paltry CD account yields. So it's not just like CD accounts in general are all high yield. No, there's definitely some banks and financial institutions out there that offer CD accounts that make me think, like, do you want to even have people opening up an account with you? Or, same thing with their savings accounts in some places. But on this channel, I focus in on those high yield CD accounts and savings accounts because I want your money to work for you and for you to earn a nice high yield on your money when I'm talking about high yield savings accounts and CD accounts. But yeah, typically with CD accounts, you're often going to have higher interest rates and yields available to you than typical savings accounts for sure, and even than most high yield savings accounts as well. And with this, that means your money grows faster over the term of the CD than it would if it was sitting in a savings account, and definitely in a checking account. Checking accounts, most of them don't even earn a yield or interest rate, and the ones that do are like 0.01 or 0.05 or maybe 0.5 or something like that. But yeah, CD accounts, you're definitely going to earn more money and interest than checking accounts for sure. I haven't never seen a checking account with a higher yield than a typical CD account. Now, high yield savings accounts, there's more of competition with those. If you've been logged in on the channel, subscribe, checking out my videos, and you're pretty familiar with the rates and yields that have been available out there in the past couple of years and currently. So with CD accounts, though, typically you're going to be higher than savings accounts and high yield savings accounts, and definitely higher than checking accounts. And for the next pro, your funds, the money you have in your account is usually insured by the FDIC, Federal Deposit Insurance Corporation, or NCUA, National Credit Union Administration. Now, when you open up an account with a bank like, Capital One, Ally, SoFi, Goldman Sachs, wherever it's going to be, you want to make sure it has FDIC insurance. Now, all of those banks I just named, they all have FDIC insurance. All the banks I talk about on my channel, when I make the videos about them, they are FDIC insured. I don't want to talk about any kind of bank opening up an account, they're high yield, any of that, blah, 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 if they don't have FDIC insurance. That's like number one stipulation for me to get on my ranking list, or for me to make a video about an account, anything like that. You have to be FDIC insured. And with that FDIC insurance, you're covered up to $250,000 in that account. So if something happened to that bank, financial institution, it goes under, goes bankrupt or something like that, your money is going to be covered typically up to that $250,000 amount. Now, for NCUA, that's for credit unions. If you're opening up an account with a credit union, you definitely want to make sure they have the NCUA insurance, because that's going to cover you as well up to $250,000 in your account if something happened to that credit union. With the online accounts, some people aren't familiar with the online accounts that offer these high rates and high yield. So they may feel a little bit, uncomfortable, worried about their money that they don't see, sitting in this account online, 100,000, 200,000, 50,000, 20,000, 10,000, 5,000, anything. They want to feel safe and confident that their money is there. Well, with FDIC insurance, your money's safe up to that $250,000 typically. Some banks or financial institutions offer higher amounts because they basically spread out your money, your deposits to different, partner banks, basically is what they call them. So that's why they'll offer that higher than $250,000 insurance. Some financial institutions do offer that. And then if you're dealing with the credit union, you definitely want to make sure it has NCUA insurance. So yeah, that is a pro with CD accounts, is that the funds are usually insured, and not just the funds that you initially deposit in the account, to start the CD, but also the interest that you're gaining in the CD within itself. That's also insured when there's FDIC or NCUA insurance. And for the next pro, there are various terms to lock in a high yield. So with CD accounts, they're offered for various terms from different financial institutions. 3, 6 months there, 9 months, 1 year, 2 years, and so on. So with that term length, that's you locking in that yield for that amount of time. You open up a CD, at 5% APY for 12 months. Well, that means for all of those 12 months, the money in that CD is going to earn 5%. No matter what happens, in the economy, even in that account itself. In a couple of months from when you open your account, that same 12-month CD the floor is APY to 4.50% for new customers. So now somebody else opening up that same 12-month CD, a few months later after you did, they're going to get that 4.5% APY instead of that 5% APY that you locked in. And so that means you'll still keep that 5% APY no matter where that APY goes for that specific financial institution, for that CD. Doesn't matter. You've got that locked in for that term length. 6 months at 4.75%. You've got that locked in for 6 months, 4.75%. Now that also can go as a con, and I'll talk about that in the con section. But for the pro section right here, you have various terms that you can lock in a high yield guaranteed, which kind of goes back to that first pro. You got that guaranteed stable yield and rate of return, but you got it locked in for a certain amount of time. So you can pretty much plan it how you want to. You got that lump sum of money. You say, I'm not going to need to touch that money for a while. I wanted to sit somewhere, but I wanted to earn some interest, but I wanted to earn a high amount of yield, high amount of interest, and I want to know what it's going to be. And I want to feel, pretty much know the math on it, know how much I'm going to get when the term is up, or, every month, because some CDs you can take the interest out every month without any kind of penalty. But for a lot of people, they want the interest just to sit there because you're going to earn interest on top of that interest. So that's compound interest, which is a great, awesome, amazing thing. If you've been on my channel following my videos, you know how much I like compound interest. So yeah, I won't go on a tangent about that, but I'll just say compound interest is awesome. So yeah, anyways, that is a pro with CD accounts, is that there are various terms to lock in a high yield. Having a certificate of deposit CD account can encourage saving. It does this because it has that yield, of course, that high yield that people are attracted to. You see that high yield, you see how much interest you're going to gain from that yield on a certain amount of money. I'm sure that motivates some people to, open up a CD, to have a CD term length, of a year, of 9 months, longer than, a month or 3 months or something like that. CDs have definitely done that for me, where it's like, I'm going to put this lump sum of money aside and have it earn some interest and not touch it. I just want to have it with that interest on top of it when the term is over. It can encourage savings by having that high yield that's attractive, of course, and it can encourage savings by having one of the cons, which I'll talk about, that early withdrawal penalty. Because if somebody knows they're going to get hit with the early withdrawal penalty, if they take the money out, they're less likely to do that. So they're going to, just wait it out unless they really need the money. Now, if they really don't need the money, then the money in that CD account is just going to sit there and gain interest. And then once you have that term up, you have that principal amount you put in plus all of that interest. So you have that kind of sitting aside. Like sometimes I've had a CD account open and I kind of forget that I have the money over there because I don't even think about it really. It's just sitting there gaining interest. But then if I think about it a little bit more, I know I'm like, oh yeah, I have that CD account over there and it's got this much money in it. Like I don't even think about it, but it's part of my net worth, part of my financial portfolio. Overall, CD accounts can encourage people to save because of that high yield and have that money locked in somewhere for a certain amount of time. And the next pro is that there are no penalty CD accounts that offer flexibility. And I talked about briefly one of the cons, that early withdrawal penalty that happens with basically non-penalty CDs, the ones that are not no penalty CDs, regular plain CD accounts, which is typical. There are more CD accounts than no penalty CD accounts. So for the regular CD accounts, they have that early withdrawal penalty, but no penalty CD accounts don't have the early withdrawal penalty. Typically with CD accounts, you have that first week or so where you're not able to withdraw the money, 5 days or something like that. But after that, with no penalty CD accounts, you can take all that money out, transfer it to another CD, another account, saves account, checking account, or wherever, and not get hit with any kind of penalty. And that's flexibility right there, because that's one of the things that turns people off from CDs is knowing that your money's locked in somewhere and you can't take it out without getting hit with the early withdrawal penalty. Now, some people don't care about that because they put money in a CD account that they know they're not going to need. They're not going to need to touch for however long time, a year, 2 years, however long. But if you have that in mind, but also want to have the availability to move that money to another CD with a higher yield or the ability to withdraw that money without any kind of penalty, then no penalty CDs might be better for you. Personally, me, I have opened up a no penalty CD before with a certain amount of money that I wasn't sure if I was going to need within a certain amount of time, but I still wanted that high yield. So I opened up a CD account. I think it was like 4.9% APY, which is nice. And just let that money sit there. It turns out I didn't need the money for that specific amount of time, but I still withdrew it out early, or about a month, I think earlier than when the term limit was up, and moved it to a high yield savings account that was actually earning more than that 4.9%. It was like 5.05% or 5%. So I moved it over there and no penalty. Didn't get hit with anything. It was nothing. It was seamless. It moved over. I think it was that day or the next day. And that was it, no penalty CD accounts. So no penalty CD accounts are definitely a pro within the realm of CD accounts because they offer that flexibility, more liquidity to your money. You can withdraw all that money, your principal, and the interest you've gained without any kind of penalty fee. All right, so I've highlighted the pros of CD accounts and went into some detail. Now let's get into the cons. First up, with the cons of CD accounts is the lack of access to funds, the lack of liquidity. Because with CD accounts, you're locking in a certain amount of money, however much money you're using for the CD account, $10,000, $20,000, $35,000, whatever it is, 9 months, 1 year, 3 months, 6 months. You're locking in that money for a certain amount of time and you don't have access to it basically, because if you do access it and withdraw, there will be an early withdrawal penalty. And I'll talk about that in the cons section more in detail. And I mentioned that some in the pro section, not as a pro, but because I was going into detail about some of the pros, but I'll mention it more in this section right here in the cons for sure. But yeah, with CD accounts, you have limited liquidity. That's one of the biggest drawbacks, is that your money is tied up for the duration of the CD term. And if you need to access your funds, you'll likely face an early withdrawal penalty. Now, the next con is that early withdrawal penalty. So yeah, there's no escaping it. With CD accounts, no penalty CD accounts. I talked about those in the pro section. With regular CD accounts, there is that drawback of early withdrawal penalties. If you need to access your funds before the CD matures, before the term limit is up for the CD, you could face significant penalties, which will reduce your overall return. Now, the early withdrawal penalty fee varies at different financial institutions and depending on the term. If you have a 6-month CD at some financial institutions and banks, the early withdrawal penalty may be 3 months worth of interest. If you have a year CD account with somewhere and you withdraw, the early withdrawal fee could be 3 to 6 months worth of interest or something like that, and so it really depends. There's different fees out there depending on the financial institution you have your CD account and the term of the CD account. But the one thing that is for sure in common with CD and early withdrawal penalties is that if you access your funds before the CD matures, you will get hit with some kind of penalty, which will reduce your overall return. If you went into this CD and thought like, okay, I'm going to earn this amount of money for this term limit and, also have it on top of my principal. Well, if you withdraw from that CD before the term ends, you're not going to get that guaranteed interest that you thought about, because that was a pro. Remember with CD accounts is that you're pretty much getting a guaranteed yield and rate of return. going into it, you pretty much have that in mind, which is encouraging savings, another pro. But if you withdraw from it early, you get hit with that con, that early withdrawal penalty, which takes away that total amount that you were going to get from that CD and all that interest. So yeah, those two right there are the biggest cons, I would say, for CD accounts, is the lack of access to funds and the limited liquidity because of that second con right there, the early withdrawal penalty. And for the next con is that the yield you lock in could be surpassed. Now, what I mean by this, let's say you open up a CD account today, right now, $10,000 at 5% APY for 1 year at Markets by Goldman Sachs. So let's say 2 months from now, a 1-year CD at Goldman Sachs is offering 5.75% APY. Well, that doesn't mean your CD is going to get bumped up to that 5.75% APY. You're still locked in at 5% APY on your money. So you could be making 5.75% APY if you open up that CD 2 months from now, but you didn't know that because, the banks aren't going to say, hey, by the way, we're going to raise the rate, 3 months from now. Some of them, they don't know because it highly depends on the federal funds rate, which I made a whole video going into detail about CD and savings rates versus the federal funds rate. And I'll link it down in the description so you can see the correlation and historical examples of how those rates interact with each other and charts, graphs, all that good stuff. Check out that video if you want to know more about that. But anyways, so yeah, with CD accounts, you're locking in a rate for a certain term limit. But if the yield on that account goes up at that financial institution or another financial institution, well, you're locked in at that rate that you got for that certain time limit. So you're out of those gains, which can work in a good way and a bad way, because we'll say, for example, that Markets by Goldman Sachs, that 1-year CD could drop down to 4% APY 3 months from now. But then that turns into a pro because you got that CD locked in at 1 year for 5% APY. Whereas now new customers who get that same CD are only going to get 4% APY. So it's a pro and it's a con about being locked into that high yield. So I mentioned it in both sections, just kind of worded it differently. But yeah, with that yield being locked in, could be a con if the APY gets raised, it goes higher. Now they do have bump up CDs at some places where if the CD yield goes up in a certain amount of time, you could be bumped up to that CD like once or twice or something like that. Typically, I've seen those CD yields be lower for those kind of certain CD accounts. And also there's like a guaranteed rate of return. Some banks word it kind of differently, where if the rate of a CD goes higher within like a week or a month or something after you open your CD, you'll get bumped up to that higher rate. Now that's not at every bank. I've seen that in the fine print of some banks and financial institutions. So that is out there, but that's usually a limited amount of time when they'll do that, So if the rate went up 3-6 months from now, they're not going to bump you up to that rate just out of, pure niceness or anything like that. You would have to take your money out and open up a new account, which could result in you getting hit with the early withdrawal penalty if it's not a no penalty CD. So yes, that could be a con right there, because if interest rates rise, yields rise, that fixed rate of your CD might end up being lower than new offerings, and you're locked into that rate agreed upon at the start. So you can lose out on the potential of hiring a higher yield. But the way I like to think about that is that, hey, for that couple of months that it took them to raise that APY or whatever, you earned interest on that money that could have just been sitting somewhere making nothing or making 0.01% or something like that. So yes, a con, not that big of a con to me, because typically APYs don't move that drastically. Now, if you've been on my channel, like I stated before, if you've been paying attention to the videos on my channel, you've been locked in on here, subscribed and everything, you know how rates have been moving, kind of the rate of how quickly they've been moving and how much they've been moving up. It's been point amounts. There's rarely a time APYs are going to jump up like 1, 2, 3, 4, 5% in a month or something like that. Just pretty gradual typically. And like I say, if you've been paying attention on my channel, you know how the rates have been moving. It's been gradual that they've been moving up in the past couple of years. Now it's kind of gradual. Well, I won't go into that. I'm going to go on a tangent, so I won't jump into all about rates and everything. Check out my other videos for that. But yeah, that could be a con right there. Let's jump into the next con. Now, another con for CD accounts is that you could have lower returns than some other investments. And by other investments, I mean stocks, ETFs, mutual funds, bonds, and so on. Now, that could be the case that stock or ETF or mutual fund could gain you more money in a certain amount of time or a shorter amount of time than that CD would. But you don't know, it's not guaranteed. You definitely have more risk involved when investing in stocks and ETFs and mutual funds. And that risk is not involved with CD accounts, because we talked about that and whole lack of risk in that situation, in that regard. But there is that possibility you could have lower returns compared to other investments. While CDs are safe, their returns are generally lower than potential earnings from stocks, bonds, or mutual funds or ETFs. On a historical standpoint, if you zoom out the stock market, typically the gain yield on the stock market in general with the S&P 500 is like 8-9%. A typical well-rounded, great financial portfolio is going to have money invested in the stock market, or individual retirement accounts, whether it be a 401k, a Roth IRA, a traditional IRA, or, a Roth IRA and a 401k, or so on and so on, and also an individual investing account. So you have those investments going on in the stock market, stocks, ETFs, mutual funds, a good mix, diversification, all that good stuff. But then you can also have your other savings where you have a high yield savings account and you have a lump sum of money in a CD account. And of course you have your checking account. So yeah, a well-rounded financial portfolio has room for investments in the stock market as well as savings in a high yield savings account and CD account. But that definitely could be a con. With that amount of money you're putting in the CD account, maybe you're putting too much money in the CD account. Maybe you should put some of that money in the stock market and then have some of it in the CD account. So that con is kind of variable because while you could want that safety of a CD account with that guaranteed rate of return, guaranteed yield and everything, maybe there could be too much money being put in that CD account. Whereas some people may have the issue they didn't put enough money in the CD account. So it just depends on your financial situation and your financial goals. And another detail that kind of goes along with those last two cons right there is inflation risk, because over long periods of time, the interest you earn on a CD may not keep pace with inflation, which could potentially reduce your purchasing power. And inflation, I'm sure you've seen it in the headlines. You felt it for sure at the grocery stores, at the gas station, so on and so on. Inflation is among us for sure. So it's just it goes back to the financial goals and your financial portfolio of how you want to be set up as far as whether or not you should have a CD account and how much money you should have in a CD account and so on and so on. Because your purchasing power could be reduced because of inflation depending on your situation. So those are the cons for CD accounts. As you see, I think the pros of a CD account outweigh the cons of a CD account, not just in terms of how many are on this list in my video, but in general. I'm not saying that everybody should have a CD account and you should put all your money in a CD account. This is not financial advice. This is for educational and entertainment purposes. But for certain situations, certain amounts of money, certain financial portfolios or financial goals, a CD, certificate of deposit account, could be a great thing. It's not something I'll always have. I don't always have a CD account open and money in a CD account, but sometimes I do, sometimes I don't. Just depends on what's going on in my life. And that's the same thing for every individual out there. It depends on what's going on in your life, your financial situation, and your financial goals. And now I'm going to go over briefly some specific CD accounts that are currently available and their APYs in the financial institutions that are offering them. In this section of the video, I want to briefly show you and talk about some of the high yield CD accounts that are offered by some well-known banks and financial institutions. Now, every other month, I do a ranking video of the top 5 CD accounts ranked by APY. You definitely check that out on my channel. There's the playlist right there and a link down in the description. And sometimes I also do the top 5 no penalty CD accounts ranked by APY. And you can see those in the playlist as well. And I'm actually going to be making those videos here soon in the next month for June. Now, let's go over these CDs at some of these well-known banks. So first up here, we have Capital One, and you see their APYs on their CDs right here. Very nice. They have a 1 year at 5%, a 2 year at 4%, and even a 5 year at 3.90%. You scroll down some more, of course, you got some of the perks, the benefits of the CDs, which correlate to some of the pros that I've gone over. And down here, you can see the terms pretty much laid out in the APY. You see the term limits that are available for their CDs and the APYs. And also they have a nice little example over here of the earnings, basically the interest you would earn on that CD for that term in that APY if you had $5,000. So you could change this amount right here, and you see the section right there on the right change. So of course, the more money you have in a CD, the more interest you're going to make. So as you see right there, 100,000, how much different that looks than 10,000. So, and so on and so on. So it's nice when they have the calculators on these sites so you can really play around and to get an idea of how much interest you could possibly earn. So those are their rates right there available on their CDs and the terms. And let's jump over to another bank. We have Markets by Goldman Sachs. Right here on their main page right here, you have a 6-month CD at 5.10% APY, and they have a slider right here for their other CDs, 9-month at 5%, 12-month at 5%, 18-month at 4.60%, 2-year at 4.20%, and so on and so on. As it goes on longer, the rate starts going down more. They even offer up to, they even offer up to 6 years of a CD. So if you're stating like, hey, I don't want any of the higher rates right now, I just want to lock in a high rate for 6 years because I think, rates are going way down further in the next couple of years, which that's the reason why some people may end up opening up a CD at, we'll say 2 year at 4.20% instead of a 9-month at 5%. They don't want to touch the CD and the amount of money anymore, but they want to keep a high rate locked in. And they think that CD rates are going to go down lower because, you know, a year from now, the highest CD that they may be offering here at Markets by Goldman Sachs could be 3% or 3.50%. Who knows, you know? So it just depends on different factors. And I've talked about that some in the video. I won't go on a tangent about that. But yeah, those are the rates and term limits offered right now by Markets by Goldman Sachs. And over here at Ally, they have some nice APYs on their CDs as well. The highest one is that 12-month CD at 4.50%. And then you have a 9-month at 4.25%, a 6-month at 4.40%, 3-month at 3%, 18-month at 4.25%, 3-year at 4%, and a 5-year at 3.90%. Let's just go over to their CDs because they have they have their raise your rate CD, which I was talking about in the video, how they'll bump up your rate, you know, and as you see, as I stated, those are typically lower APY starting than other CDs. So 3.75% on that one. So their no penalty CD account, I want to show you this one. So Ally currently offers a no penalty CD account at 4% APY. We're going to click on it to see the term limit of this one. I think it's, and this one is for 11 months. So often with the no penalty CDs, banks and financial institutions don't have like various term limits for those. It's usually like only 1 or 2, maybe 3, something like that, but not as many as their no penalty CDs. So with Ally, they just have one no penalty CD and it's 11 months at 4% APY. Another thing Ally had on their website I thought was kind of neat. I'm going to go back over here. So they have a comparison down here of some CDs offered at other well-known banks. So Capital One, we actually talked about that one just now. They have American Express right here, Citibank, Bank of America, and Chase. As I stated in the video, there are some well-known banks and financial institutions that offer very paltry yields on their CD accounts even. So as you see right here, those are a couple of examples of Bank of America and Chase. Those are the 2 largest banks in the United States based on total assets. JP Morgan Chase, #1, and Bank of America, #2. And for some reason, their CD yields are just incredibly low. But, you know, I guess they don't really just want to attract a bunch of people to their CDs. I don't know the reasoning behind it. They definitely have the money to offer it. They're large banks. I like their stocks, but hey, when it comes to CDs, that's not somewhere I would open a CD. But yeah, so that's Ally right there. Ally is a place I would open a CD. I actually have had a CD with Ally before, worked out great. And another place I've had a CD is at CIT Bank. And let's look at their current rates right here. They have an 18-month at 3%, 13-month at 3.50%, and 6-month at 3%. Outside of that, their other terms have really low APYs. The 5-year and 4-year have 0.50%, the 3-year and 2-year have 0.40%, and the 1-year has 0.30%. So very low on many of their CDs, but they have a couple of CDs that have a higher APY. And as I'm kind of going through these different CDs, I could definitely see a trend of the yields going down. And I talk about that on my ranking video of the top 5 CDs ranked by APY, but there is a trend of APYs with CDs kind of being stagnant, going sideways, and being lowered, going down. With CIT Bank, they also offer a no penalty CD. It's 11 months as well. They have a no penalty CD at 3.50% for 11 months. And they also have that ramp up CD, which can bump the rate up. They have a link for it, but it's currently not available for new accounts. And let's jump over to one more bank here, Citi, which I believe is the 3rd or 4th largest bank in the United States based on total assets. But they actually have CD accounts that have a nice high yield on them, especially compared to their 2 larger banks, Bank of America and JP Morgan Chase. So let's look at their rates here. Their featured rates right here are definitely higher than their other rates, and that's why they're at the top. So you have a 9-month at 3.75%, a 6-month at 4.75%, and a 15-month at 4%. Besides that, all of their other CDs are under 1%. So yeah, you see all their different terms right here. They have a lot of different terms: 3-month, 4-month, 5-month, 7, 8, and so on and so on. So I'm pretty sure with those banks, you either heard of all of them or most of them. And I just wanted to highlight that because when people all think about CD accounts and they see the rates and things, and they maybe see my ranking videos, they see banks and financial institutions they haven't heard about, they're not comfortable with, they don't know much about, and so they may be hesitant to put money there. But there are well-known banks out there with nice high APYs on their CD accounts as well, and I just want to briefly show you some of them in this video. In summary, CDs can be a solid option for conservative investors looking for stability and guaranteed returns. However, they're not for everyone, especially if you need quick access to your funds or are looking for higher growth potential. If you found this video helpful, please give it a thumbs up and let me know in the comments if you have any questions or if there are any other topics you'd like me to cover. Don't forget to subscribe and share the video with your friends and family. Thanks for watching. Hope you enjoyed the video. Take care.